Hi, everyone. Welcome to Tech Talk, a podcast where Amit and I tackle various technology related topics and talk about it. We don't just talk about the technical side, we also talk about the social implication of those technologies in our lives. Today, we're going to talk about digital trading. This is a topic that is not covered very much. We thought this would be a really good topic for us to talk about, for our audience to be aware of everything, all the things that are out there for us to utilize, as well as to be cautious of. What is digital trading?
So I think thanks again, Rinat, for that lovely introduction. And I would like to start with trading itself. Trading started with trading of goods, goods of certain value. And when you trade goods of certain value, and what trading means is exchange of goods. So say you have a lot of wheat and you want to exchange it for a lot of rice. And then you you exchange wheat for rice, you make a trade. Or you buy some paddy with a lot of money, and say you buy it for say $100, and then you sell it for $200 to a different place, different location. So then you make a profit. So these are different types of trade. You exchange and then you sell it for profit. So that's trading in conventional sense. And when we talk about digital trading or electronic trading or trading, we are talking about financial assets. And what do you mean by financial assets? So financial assets are anything like your stocks, your bonds, your commodities, foreign exchange, index funds, etc. Okay, so there are different types of assets that financial assets that you can buy, and you can trade them on different exchanges like the stock exchange, or there are markets where you can trade, say cryptocurrencies. So digital trading also encompasses not just financial assets but digital assets. So what are digital assets? Cryptocurrencies, Bitcoin, Ethereum, then NFTs, which we have already spoken about. So all these are digital assets and you want to trade them. So you go to a place and you buy these digital currencies. Say you go to Binance or Coinbase and you buy the digital currencies, or you go to an NFT exchange and you buy the NFTs. So these are nothing but different types of trades. So digital trading combines electronic trading and trading or paper trading that used to happen previously ages back.
Yes, this is, I actually think it's really nice that you started with the actual part of trading. And, a lot of us usually would call it bartering. And when we usually try to explain the origin of money and how it came about, we then first start with how in earlier, ages, humans used to barter first, and then came the concept of money. But interestingly enough, a little bit of side topic. Interesting enough, that apparently has been proven wrong. Apparently, that's not how money was invented. But this is a completely different topic, so we're gonna tackle that again, maybe in another episode. But it is true that we did used to barter in different ways. I needed rice, you needed mango, or someone else needed lentils or whatever. And we traded between these things. And when we traded, it's in the word. We traded when we wanted different things, and different people had those array of things. We had to trade. Now, the invention of money or the need of money, that's another side. But in order to be able to trade, we had to all meet in one place, which would basically where we would all sort of present what we have to offer, and we could see what everyone else has to offer, and then we could sort of engage in some sort of agreement that I'll give you this much of what I have in exchange of what you have. And this common location, I mean, obviously in earlier days there was no internet or Wi-Fi or websites to do this. We actually had to meet in physical locations, and that's what we used to call marketplace. And we used to meet in these marketplaces and then present everything that we have to trade we wanted to sell and also we wanted to buy. So we wanted to sort of communicate with the rest of the traders that this is what we want to buy or sell. Now imagine if we wanted to sort of buy rice, because that's a staple food. Every household needs some rice, and many people, as you would imagine, many people would want rice to sort of, because it's not easily perishable. So as far as food goes, a lot of people would probably want to have rice, some stocked rice in their household. So imagine if we meet, all of us meet in a marketplace where we have different things. Some have mango, some have banana, some have lentils, and some have rice. And all of these are limited. But then there is a lot of demand for rice. A lot of people want rice, and then there isn't enough rice. That would create a sort
Demand and
of
supply imbalance.
supply and demand issue, and that
Imbalance.
would
Yeah.
cause, what would be the logical consequence is that only a few people would be able to buy rice, and the seller would only sell to the people who, in a fair marketplace, the seller would be able to sell it to whoever is the highest bidder. And now, obviously, before the age of internet, this was very difficult to do, because in order for you to know who is able to bid the highest for, say, 1 kilo of rice, it would be very difficult to do it manually. And in one marketplace, the rice could be valued differently than a completely different value just half a mile away in a different marketplace. So this wasn't fair for anyone really, because ultimately, seller or buyer, they all risk losing out, because the prices and everything was not synced up globally or nationwide, and it was just within that marketplace. And there were so many other issues of like manhandling and unfair sort of coercion and stuff like that. Now all of these things that we don't even consider being a problem in nowadays is because of the advent of digital trading. Because nowadays we don't have to meet in person. Not only the hassle of going to a marketplace physically with our tons and tons of truckload of rice, but also we can actually ensure that we are getting the fair market value of, spreading it out, that this is what I have to offer, and whoever wants to pay the best value for what I have to offer can get it. So that all of that is becoming possible because of the marketplace being digital. And that's what we're going to talk about today in more detail, in digital trading, how the trading, making it digital, making our lives easier.
Well, I think you've summarized it really well. Even I couldn't do better than that. So there are a couple of things I take from that is firstly the marketplace. So if you look at the global trade routes, which were there in the earlier ancient times, the you think about the Silk route, you think about the spice route, you think about the slave route. There was sugar, tea, coffee. These were traded. So people used to come to the Indian subcontinent to get the spices. They used to go to China for the silk. Then there were other resources like sugar that was planted in the Caribbean, and the slaves were to work on those sugar plantations were taken from Africa. So there was a global trade happening of goods and people, and this trade enabled the civilizations to thrive, because then they could, even if they can't grow something in their own land, they can go to a different land, buy that good, and sell it in their country at a maybe profit or whatever. And that's how trades happened. And you were right. People used to bid for the highest bidder would get the rice. And the way they would do it is by calling out loud. So that's why you still see in stock exchange, some of the stock exchange, that there are people who are shouting, because they have like, okay, someone is willing to buy 1,000 stocks of Google, or $1 million worth of stocks for Google. Someone is shouting like that in the stock exchange, and if anyone is willing to buy or sell those stocks to this person, then they have a deal. That's how trade is finalized. What happens with the nuances of trading is, who has given what bid, what has the contract been agreed upon, what has the price that has been agreed upon, what good is being sold, what is the value, what is it being exchanged for, is it being exchanged for money or some other goods, etc. So those were written down initially, maybe you were initially calling it, but then eventually they were written down. And then written down means that it's a cumbersome process, it takes time, someone has to audit the documents, and then someone has to keep track about, okay, what goods were sold when, and if there is a dispute, how do you settle the dispute. So those things happened over a period of time, and then gradually you started having electronic trade. That meant that you can now do a trade electronically. So it means the contract is signed electronically, the purchase of goods is done electronically, the bidding is done electronically, the order is sent electronically, etc. So that's electronic, completely electronic. And then you had the advent of digital assets. So again, if you look back at the exchanges, exchanges are very local to a region. So New York Stock Exchange is New York based, London Stock Exchange is London based, Bombay Stock Exchange is Bombay, Shanghai, Japan. So there are different stock exchanges. Each stock exchange will have their local stocks to trade. So suppose I want to buy a Google share. Where is Google share being traded? They are being traded on the New York Stock Exchange. Are they being traded in London? Maybe they are because they have an office here. So they can actually trade here legally because they have a company and they can trade here. So then it means if you want to buy a financial asset, you'll have to go to that specific exchange. And then you have to look whether that exchange provides other assets like commodities or forex. So say for example, I have an order to buy Google. I want to buy it from New York Stock Exchange, but I don't want to go to the New York Stock Exchange website, place an order. So there are brokers. So there are investment brokers or stock brokers. So these brokers, what they do is, and this happened before the different types of websites that emerged. So these brokers, they used to take your order and they used to place it at the exchange, and then once the order is completed, they used to tell, okay, now you have these stocks. Then we had the dematerialization of accounts, like demat accounts, where you were actually storing the contracts, the digital contracts, and these were stored. But now, like with a platform like Trading 212, which we both use, we can buy
And
a
Robinhood
stock,
in
and
the
Robinhood.
US. Yeah.
So we can buy a stock on any exchange and any type of stocks. And we cannot buy not just stocks, we can buy cryptocurrencies, we can buy index funds, we can buy maybe forex, etc. So it gives us a lot of flexibility now without opening an account. And these websites are acting like a trading broker or a stock broker. But now they are encompassing not just one type of financial asset, but different types of financial assets. And that's where the digital trading is now getting so popular because it's now easily with a click of a button, you can do a trade. And when we talk about digital trading, we are talking about individual investors. We are not talking about institutional investors, big organizations like hedge fund companies or index fund companies that buy stocks in bulk, like in millions of stocks, because they manage a huge amount of funds. So those are institutional funds, say pension funds. So pension companies, they invest in stock market, and there are many other companies they invest in stock markets. But we are not talking about that. We are talking about individual investors like us who want to do a trade online.
Absolutely. I mean, as you mentioned, this is such a vast area of trading. There are different types of assets that you can trade. There are different types of platforms that you can trade on, and then there are different types of traders, if you like retail investors, like you and I, and the audience potentially, and institutional investors. So there's so many nuances of trading, and we need to be aware of all the different things that's happening right now in trading to be able to make an informed decision. I know, obviously, you can't know it all and you can't predict everything, because then whoever could would very quickly become a millionaire. But it's still a very good practice to understand all the different things at play here. So if we cover it one by one, from if we start from the type of the things you trade, like, thousands of years ago, it was rice and, wheat and whatever. So nowadays we have different things that we trade. We have stocks and shares. So stocks are various sort of assets. It could be, I mean, I am not 100% because I'm not like a finance guy, but it could be gold and silver and then precious metals. And it could be other things like food and sort of wheat and all of these kind of things. And shares are sort of usually said to be shares of successful companies, which are successful public companies, which sort of distributing their shares to the public. Which example of this is like Google and Apple and Adidas
But
and
here I want to add, like, it's not just successful companies, it's also companies that are trying to raise money from the stock market.
yes.
The reason being that they can introduce a share, they can give a piece of their company, and they can say that, okay, we are giving you a piece of our company, you give us money in lieu of that. And then people who
Mhm.
believe in the company, they'll invest in that particular stock or share and they'll buy it.
Yes, yes, absolutely. So that could be another motivation for a company to be in the public market. So there are stocks, there are various stocks of which are like actual assets, physical assets, and then there are shares which are owning very small part of the company. And then there are other kind of, if we expand out, there are other kind of digital assets like cryptocurrency. And then there are another thing called forex trading. Forex stands for foreign exchange. So there are various, the actual foreign currencies. So if you're in UK, you might want to buy some US dollars or other euro or Japanese yen or whatever you want to exchange as you see fit. If you think that the value of pound will go up, then maybe you want to trade based on that. Or if you think the value of dollar or euro will go up or down, you might want to decide your trade based on that. So that's the things that you buy or sell. And
One thing you forgot is commodities, which is oil.
yes.
Oil, rare earth metals, iron, all those things. So people trade on commodities as well, silver, gold, etc.
Yes, yes. So that's the things that you trade. And then there is the trading platform itself. As you mentioned, Amit, Trading 2121, and Robinhood are some of the ones that I really praise because they revolutionized the whole of the trading game for retail investors. Because you and I, or just mass population who have just a little bit of money saved up, and they don't want the money to be depreciated under the couch in their cash savings. They want to buy some sort of asset which will appreciate in value, if not appreciate to a to a significant level, at least to keep up with the inflation. So they could potentially just want to buy an S&P 500, a fractional share of that. So all of this is being possible for platforms like Trading 212 or Robinhood, which is in US. But there are other trading platforms as well, which have a bigger range of things that you can trade. For example, wheat and rice and things like that you can't potentially trade in Trading 212. But Trading 212 also has a really vast array of things that you can trade. So I personally use Trading 212, and I never felt like I'm missing out on something. So yeah, but there are other platforms like Hargreaves, Lansdown, and then many other names that a quick Google search will reveal. So those are the platforms that enable you to trade. And in terms of cryptocurrency, there are Coinbase and Binance, two of the bigger ones, and then there are a few others as well. So those are platforms, and then the question comes as what was the third thing?
What type of trader you are?
Yeah, what type of, so there are various financial products. You could think about shares, that when you're buying a share, you're buying a very tiny part of ownership of that company. But then there are trading 212 allows you to do CFD trading, which is a different type of trading altogether. And that is to do with short selling and long selling. That is basically you're betting whether the price of the stock will go up or down in future, sometimes in a week's time or in a month's time. So there are products, financial products like that, and then there are many other financial products like futures and a few others. And these are financial products that you can sort of interact with. I don't want to use the word trade because I'm not a trade, like a finance guy, so I don't know all the right terminology. But all in all, there are technology right now that we can avail to enable us to do all of these different things in different marketplaces that wasn't available even 5 or 10 years ago. So that's the amazing part, that the technology behind it is letting us, the regular population, to be a part of this investing world and make a sort of a very small yet significant impact. So even institutional investors have to sometimes think about this. And an example of this is GameStop, which is when retail investors completely took down institutional investors.
There is a money that's being made. Sorry, not money. There is a movie that's going to come out, which is called Dumb Money, which is on GameStop and Robinhood. So
Yes.
so it's incredible. Like it talks about the whole story. But I think I wanted to cover some basics as well before we go. I mean, before we go further. One of the things when we talk about trading is that you place an order. Say you want to buy 100 shares in a company. Now the thing is, why do you want to buy 100 shares? You want to buy 100 shares because firstly you want ownership, and firstly then you want a return on your investment. So you think that owning this company will give me a return 10 years in the future or maybe 1 year down the line. So if I buy the share of a company today for $10, but by the end of the year it will go to $100, I get a good return on my initial investment. And that's why I want to invest. And some people invest longer because they think that the value will go even higher than what it is currently today. So if you stay in the game for a very long period of time, until unless the company goes bankrupt, say if you've invested in Google 10 years or 20 years ago, you would be quite rich if you had invested a lot of money. So again, the trade game becomes different when you invest a small amount or a big amount. And initially, when you had to place a trade, it had to be like in whole amounts. I want to buy 100 shares. You couldn't buy it in fractional amounts. I want to buy zero point 0.1 index fund, zero point 0.1 share, which you can do with the current platforms. And then when you are actually placing the order earlier, you would place it through a trader or a broker or whatever, and they used to charge a commission. Trading 212 and these platforms, what they do is they don't charge you any commission. So that's the game changer. How does their business model work? I'm still trying to figure it out. But currently they don't charge you for any commission. So whatever price you pay, whatever price you are shown for that particular stock, you get that stock. And
Yeah, so this is kind of the dark side of this kind of platforms, which are enabling, which are, I think, overall, after doing all the plus and minus, I would still be for these kind of platforms, Trading 212 and Robinhood, because it's enabling you to do something that you could never do before profitably, because every single trade you would request would have like £4, £5, or dollars charge, which just completely makes it too risky for small investors who wants to invest £100 in one stock, because £5 is just going to, which is 5% of their trade, and then guaranteeing that particular share will go up more than 5% its value is quite risky.
quite
So
risky.
it was just impossible. But there is a dark side to trading 212 and Robinhood, and they have to make money. So one way, I don't know about Robinhood very much. One way trading 212 may make money, and I haven't done enough research to guarantee and confidently say these things, but I have done some research which I can sort of rely upon. So one way trading 212 makes money is the foreign exchange. So if you sort of buy something in New York Stock Exchange, which is bought in dollars. You are in UK, you're paying in British pounds. So the foreign exchange fee, they do charge a very little amount, 50 fraction of a penny for each of these, but obviously they add up with thousands, tens or
If you
hundreds
do a
of
lot of
thousands
trades, then it
of
adds up.
trade
Yes.
from all of the people. So that's one thing. And the other thing is you don't get the best value in the market. So when you place a market order that I want to buy one Apple share, when you place it, you won't get the microsecond that when you place the order, that price you probably won't get. They will sell your intention of buying one Apple share a few microseconds before you to large banks and large corporations. So they get the a few seconds before, that information a few seconds or microseconds before you, so they can do something with that information, which I don't know exactly how it works, and I would encourage you guys to sort of do your research, and please also tell us, enlighten us, so we could share with the rest of the audience as well. But our intention of selling or buying is is sold to large corporations a few microseconds before us, so they can aggregate all of these intentions every microseconds, and then they can make more informed purchase or selling decisions, which obviously makes them more money. But as a individual investor, you were not going to make this wasn't going to make any difference to you anyway, because whether an Apple share right now is maybe $100, and if by the time the buying order is processed, you probably would buy it for $100.01, which is not really going to make much difference as an individual investor. But a corporation who is buying a million shares, which is like tens, 100 million pounds or dollars, it will make a big difference for them. So I would still encourage to definitely put yourselves in this situation to learn and make your own decisions after thorough research. But definitely is, I think it's still worth it.
Yeah, and while you were talking about all this, I was just checking my trading 212 account, and I actually have a stock for a company, and the amount of shares I have for that is 115 point something. So I actually own a fraction of a share. I don't own that share completely. I own a fraction of that share, and this is something that could not be done previously. So this has now started happening, because earlier you also have to think, like, you will try to sell it at a price, but someone has to be willing to buy it at that price. And if more people are selling it at a lower price because they just want to get rid of the stock, the price falls. And if more people are willing to buy it at a higher price, the stock value goes up. So that's how the stock market is played. Like, you need to understand the basics of how the price goes up and down. And then with these tools, you have different mechanisms. So like, say, if a stock value is going down continuously for a certain like percentage, then you can I think you do what you do something like a stop or something, right? You
Yeah, there
stop
are
stop
various
loss, stop
Yeah, there are
something
various
like that.
tools like that where you could put a stop sale or a limit order and things like that, which helps you making a
So
decision.
basically, what these tools help you to do is that it will prevent your losses. I mean, reduce your losses, not prevent, reduce your losses. So if something is falling down, then it reduces your losses to a certain limit. So it will automatically make a trade on your behalf if you set a limit. So that's again the benefit of this. Like, if it reaches a certain limit that you have defined, it will make a trade on your behalf, saying that, okay, it has reached a limit, I cannot bear further losses. So those are the different things. But in trading itself, you have different types of trading, like day trading. So I buy something today and I sell it before the exchange closes today. And in that period, I'll try to predict if it will go up or down. Normally, I will predict that it will go down. So, sorry, up. So if it goes up, I buy it say $1, it goes up by $1.5. And that's where day traders come. They buy a million shares at $1. And at the end of the day, if they are able to sell it for $1.5 per share, that 1 million suddenly becomes 1.5 million. So that's how they make huge profits. That's where day trading is there, and it's completely legal. You can do it, but you have to be very, very careful because you can lose a lot of money very quickly. A lot of people have.
Yeah, exactly. The other side of what the example you just gave, that $1 of share could become 50p at the
50p,
end of the
exactly.
day. And then you can very quickly, within a day's range, you lose $500,000. So that could also happen. So and also only I think there was some sort of statistics that the only 20 to 30% of day traders actually profit from the market. So it's less than 50%. So unless you're very knowledgeable and you're very, you've done your research to a degree that you're above 70% of the people who are in the market. And bear in mind, there are like Harvard, Oxford, Cambridge graduates and analysts who's spent their whole life researching various companies. So unless you are confident enough that you're above 70% of the whole marketplace, then you shouldn't be day trading is what my advice is. But yeah, I mean, of course, this option is open for you, and there are also a lot of virtual marketplaces where you could actually interact with the real life marketplace with virtual currency. For example, trading 212 in UK, that gives you this option where you basically have open the account and have everything open and set up, and then they give you like a fake money for £50,000 or whatever, or you can decide how much money you want to start with, just so you can practice. And then you would decide whether these 10 different companies share or 100 or 200 different companies share you want to buy, and then you see that whether how you performed, and you can play this virtual game for as many days or years as you want, to build up confidence and to understand how the whole thing works. And then once you are confident enough, then you can start with real money that you can transfer from your
Yeah.
bank account. But there's not just trading 212, many banks have this
I've
sort
done
of.
that on IG.com, and I think one of the things is you understand how to do a trade, but you also understand the platform itself, like what are the different options on the platform, how to use some of those features, etc. So basically, these platforms they give you this virtual currency so that you can understand the platform, understand the mechanisms with which you trade. But as Rinat mentioned, day trading is a very risky business. Only 10-20% of people actually make money out of it, and that's why you should look at trading as an investment. So you are investing in a company for a certain period of time. So you invest money thinking that it will give you a return maybe 6 months, 1 year, 2 years down the line, and you forget about that money. And the way
Or
you
even
reduce,
more,
yeah,
five,
even
ten
more, even
years
even more, say for Google, because the price keeps going up. And now the thing is, these stocks are in your name, right? And if trading 212 closes tomorrow, those stocks are still in your name. So even if the company goes bankrupt, because the stocks are in your name, you own the piece of the company, you can still transfer your shares. So that's how stocks are better than, say, having cash, because then you have a legal right to the share of the company because you have the ownership. You have paid money to buy that. Okay. Apart from that, I mean, you have invested for a long period of time. What happens is companies they start paying you dividend every quarter or every half yearly. They'll announce a dividend, and they will say, because we have made this much profit in this year, we want to return or give some money back to our investors. And the way we want to do it is by giving a percentage of the value. So they'll say 10p, on the face value, or say 100p on the face value, we'll distribute. So if you have 100 shares and the dividend is 50p, you'll get £5. Okay, so something like that. And that's a huge incentive, because if you have a lot of shares, then you'll get a lot of dividend. And there are different rules as well, because see, we are talking about investment, but then you have to think about tax as well. So you are gaining an interest. A dividend is nothing but an interest on the amount that you have invested. That interest, you can pay tax on it, defined by the government, and there are different slabs, so we'll not get into it. But of course, you have invested some capital in a stock, so there is something called as a capital gain interest. There are certain limits depending upon how much you earn. So based on that, the tax slabs are defined, and then you pay the tax accordingly. And again, another advantage of using such platform is you're not just buying stocks. You can buy cryptocurrencies, blockchain, sorry, not blockchain, Bitcoin, Ethereum, etc. And you can buy these on the platform. And as Renat mentioned, they don't charge commission. They might charge commission for forex and maybe crypto, but not for the regular stocks. And when you say commission free trading, it means there is no commission on buying a share and no commission on selling a share. Because if you look at the previous platforms, the platforms from previous generation before this transformation happened, they used to charge commission on every trade. There was a commission on selling, there was a commission on buying, there was a commission on, if you do 100 trades, there was a commission for so many trades. Then they simplified, they said unlimited trades in a month, but you'll have to pay for buy or this. And there were different types of things. So that's how the platforms earn money. And these new platforms, they are changing the game, because they are now offering commission free trading. So imagine, like, you don't have to pay a lot of money to start investing, but it still has a limitation. The limitation is it will not have every single stock listed on the exchange. It will not have, it might have some large cap companies, some mid cap, and some small cap, but it will not have all the cap companies. Large cap means large capital, big companies like Google, Alphabet, who have, not Alphabet, Apple, they have huge capital, like they have millions and billions of dollars invested in the stock exchange through their shares. But then there are medium cap, so they are not very big, but they are big enough. Say banks, maybe you can consider some small banks a medium cap. And then there are the small caps, which have just like started a startup or something like that. They are not huge, but they are trying to leverage money from the stock market. And then again, getting listed on the stock market is also not very easy. You have to meet certain criteria before you get listed on the stock market. So there is a whole lot of things. But the whole idea of explaining all this is that there is a platform where you can buy certain assets and you can profit from it. Like, I'm just looking at my trading to an account right now. I've just bought one company's share, about 115 of them. I've made a profit. Uh, yeah, I've made a profit. The profit has just suddenly gone down because the price changed. So now you can see your real-time performance. And these indicators are not possible previously because you had to log in somewhere. Now you have everything on a mobile app, so it makes life so much easy. So that's the benefit of using these platforms.
Yes, yes, absolutely. And all of the none of the things, just wanted to put a little bit of disclaimers, that none of the things Amit and I shared with you guys are just for information purpose only. These are not professional financial advice in any way. And
Yes,
also, we are not
they're not
sponsored by
money.
Trading 212 or anyone else who made us say anything biased. It's just our personal experiences, and we are sort of educating you guys in terms in digital trading platforms, not necessarily just Trading 212 or Coinbase or Binance, but all of them all together, where you can, these are different marketplaces, just like thousands of years ago, where you would have different areas, maybe in London or New York, you'll have marketplaces where everyone would come gather around. These are the marketplaces which are dedicated for different types of assets, like Binance or Coinbase are for cryptocurrency. Trading 212, Vanguard, Hargreaves, Lansdown, Robinhood, these are for trading assets and shares of companies, and various others for various. So these are marketplaces that you want to be aware of, whether you want to sort of get into investing and things like that. But yeah, no, none of this is financial advice. But at the same time, not as an advice, what I would do, I would tell you, is this: the safest way of investing in the ever evolving and ever volatile market of shares or crypto or whatever. I personally think the safest way of investing in this kind of thing is a term called dollar cost averaging, which means that you're saving a certain amount. Maybe you get paid monthly or weekly, a certain amount every week or every month you kind of put aside for saving, and then you buy a ETF or exchange traded funds. These are like an aggregate of various different companies, which basically diversifies the risk, which is basically less risky, if you'd like. So if for me, what I would do, and this is again not an advice, but what I would do is do this thing called dollar cost averaging, which means that every month you set aside a certain amount, like $100 or £100, and buy. What I would do is S&P 500, which is a ETF of the top 500 US companies, and historically this has always gone up by 5 to 8% in the last 100 years. So that, I think, is a good place to start while you figure out the rest of the things. But yeah, dollar cost averaging on S&P 500 is what you want to Google if you want to start out on digital trading platforms.
And for those people in the UK, I invest in index funds using Vanguard on FTSE 100. So index funds are similar to ETF. I don't know the exact difference, but index funds are also group of shares. So there are like group of 100 shares, and there is a percentage invested in each of these companies based on which is doing better. And FTSE manages this, and then you can buy the index fund through Vanguard. And the best thing is that it gives you about 8 to 9% return. So you don't have to invest in one company, you're investing in different companies, but then you're not investing in different companies directly. You're buying a fund that invests on your behalf. So it's a safe bet because you are then giving the ownership of trading to experts. Plus, you don't have to then do the research yourself. You don't have to spend time and effort in trying to figure out what's the right thing to do, what's the wrong thing to do, etc. So you leave the thinking to the experts who have trained, who have got knowledge in this market, and we don't. So it's easy. Or buy some stocks on Trading 212 with money that you are willing to lose. In the sense, say if you have £10 or £50 to lose, which you think, like you go to a casino and you try to gamble, right, for the fun part, because you like the adrenaline of throwing some losing some money, not losing but thinking that you might make some money. So that's how casinos work. So same way you can go on Trading 212 with some capital, £10, £50, try to buy some stocks, see which are the good ones, which are the bad ones. You read the news, and then buy something and just see and just stick with it. Even if it is a bad performing stock, just stick with it. See how the performance changes up and down over the period of say 1 year, 2 year. Because see, you have first invested something that you're willing to lose, and you have learned how to invest on a new platform, and then you have learned how to be patient with your investment. And these are very important things. Like you have to be very patient. If you are like those day traders, you'll make a huge loss. Well, if you are able to beat the odds, you can make a huge gain as well, but that's where the risk comes.
Yes, absolutely, absolutely, and this is also again my ideology as well. And these are some of the things that are actually said in every like advertise or wherever, that capital at risk. You will hear that in many places, and everything about trading is uncertain, but there are few things that are 100% certain, which is one of those things are capital at risk, which is basically before you start you need to have this mindset that whatever capital you have, the whole of it is at risk. You might think that, oh, Apple is such an established company, or Google Alphabet is such an established company. If I buy their shares, yeah, the share price may go down, but it's not going to come down to near zero, because it's a, but that's not guaranteed. And I've been trading for quite some time, 4 or 5 years, and I have seen established companies completely go down near zero. So in pennies, so it's actually same as being zero. And then there is another sort of line which is definitely always true, which is past performance cannot predict future gains. So a lot of the times, as soon as you start doing researches, you'll probably see a lot of people are analyzing past data in terms of trying to find patterns of how how the share or the cryptocurrency or foreign currency performed in the past, to predict how it would perform in the future. But this is another kind of, if you want to write 10 commandments of share trading, these would be the two on top: capital at risk, and the second one would be past performance cannot predict future performance. And that is absolutely 100% true. And do not deviate from this knowledge that you can spend a lot of time analyzing the past share going up and down, and finding patterns, and finding this kind of M pattern or whatever, bullish, bearish, but it cannot guarantee anything on how it will behave in the future. So be aware, be very careful and cautious. But again, I would still encourage you. We're telling you all the things to be cautious of, not to discourage you, but to actually ultimately encourage you, but go forward cautiously, knowing all the things that can go wrong, so you can sort of have a more informed decision as you sort of try this out. But yeah, the whole point of our talk today is the digital trading platforms enabled individual investors like you and I to sort of be part of this marketplace that we couldn't do before. So whether you want to buy Bitcoin or a bit of Turkish lira or a Japanese yen in Forex, foreign currency exchange, or if you want to buy a bit of Google, Apple, or Microsoft in trading, wherever you want to go to, all of these are now in your fingertips, potentially in your mobile app, if not in your desktop. So all of these things are enabled and available to you as an individual, thanks to digital trading platforms. And that's what's available nowadays to us.
Yeah, and I think one of the things which while you were talking, I picked up is uncertainty and the risk, and the other one was about the changing future of companies. I think if you look at why we recommended S&P 500 or FTSE 100 is that over a period of say 30 or 100 years, the list has changed. So somebody that was on top is no longer at top. So today Apple is at top, but tomorrow Apple may not be there. And that's why the list changes. And that's why it's safer to invest in these funds, because then you don't have to figure out who is on top or who's at the bottom. They take that risk, they do the analysis, and they put it. So S&P, Standard and Poor, they decide who are the top 500 companies. FTSE decides who are the top 100 companies, and they prepare a list. And then there are companies like Vanguard who prepare an index fund. They invest in these companies. You don't have to worry about it. So 100 years down the line, we don't know which companies will remain, because technology is changing so rapidly that you can't predict anything. And the second point was about uncertainty and why there is uncertainty. So imagine I want to buy some rice. Now, tomorrow there is a flood, or tomorrow there is a drought, and I know, and I don't know. So I don't know because I don't have weather data. There is a drought, there is no rice crop. So whatever I have rice, now it's suddenly in huge demand, and people are willing to pay me more money for rice because now there is a drought, and it's less in demand. but there was an uncertainty because no one knew that there could be a drought. Okay, so and then later down the line, there was an earthquake, so a lot of people died. Okay, elections happened and governments changed, so the policies changed. So some companies were impacted more than other companies. These are things you can't predict from a graph. A lot of people, when they try to predict a graph, they look at formulas and mathematics. But how do you predict the outcome of an election? How do you predict whether an earthquake will come tomorrow there or not? No, you can't predict that. And that's where the uncertainty is. And that's how stock market should not be there to predict the future. It is just so that you invest. Okay. No matter if even if there is an earthquake, Google will still survive. Maybe for a year, maybe for next 10 years, till the next company emerges, but it will still survive the earthquake. It will still survive the drought. So you don't have to worry about that because you're investing for the long term. But if you try to predict the market based on a graph, the graph can't predict all these things of what's happening, and the market is influenced by that. How does the company price go up? Because the company is making more money. How does a company make more money? By selling more goods. But if there is a strike, if there is a earthquake, if there is a flood, then the company can't sell enough goods. If there is a COVID, there is a lockdown. So a lot of companies they lost their value. So that's how this uncertainty can't be predicted. No one predicted COVID would happen, but it did happen. And a lot of companies they got bankrupt because they were like, how do we survive in a market like this? So they had to be bailed out by the government because government said, okay, fine, we will help you because this is an unprecedented situation. And you cannot predict that using a graph that okay, it performed well this year well, so it will perform this well next year. You can't predict that.
Absolutely, absolutely. So, hope you guys had a good insight on various digital trading platforms and all the options that are open to you guys. We do encourage you guys to check everything out and potentially do get involved and put yourselves out there because that's the only way to sort of progress. As in life, as an individual and as a society, we need to sort of branch out to experience new things that are available. But again, the whole point of this conversation today was to educate you on the concerns so you can make an informed and cautious step forward, but definitely do step forward nonetheless. So that's the message, and hope you guys have enjoyed our conversation today. We have thoroughly enjoyed it. I'm sure Amit would agree. And we hope to see you again in our next episode. And please do let us know. We are available, just a quick Google search away. I mean, our links are available below in the description all the time, but we are also available in all kinds of social media from LinkedIn to Facebook, wherever, if you just look, search with our names. So do reach out to us, give us your feedback or questions or suggestions, or if you'd like to come on with in our podcast as a guest, we would would like it very much to welcome you and talk to you about various things. So yeah, look forward to hearing from all of you, and thank you very much for tuning in.
Yeah, thanks a lot. Really enjoyed the conversation. Thanks.